Hello, I'm Suzanne Ford. I'm a licensed investment advisor, and I've been helping individual investors buy stocks for 30 years. This short seminar is designed to help you build a portfolio of diversified, high-quality stocks. It's a step-by-step plan, and it's designed to build your wealth. Congratulations! You have discovered that just like with your children, no one cares more about your money than you do. And just like your children, you need to watch your stocks and learn how to do it yourself. But people will tell you not to, won't they? People will tell you stocks are way too risky. I've lost all my money in stocks. It's just a gambling game. But I'm here to tell you that stocks are the single best investment in U.S. history. Let's look at the facts. If we want to look at a stock market chart, this is the Dow Jones Industrial Average since 1900. And if it was extended out through today, it would be up through the top line. As you can see, stocks have always gone up over a long period of time. But the truth is also that the individual investors have not done this well. Let's look at the facts. The truth is that inflation accounts for about $11 for every $1 that we put in the market in 1905. But if we had invested $11 of our money in the market in 1905 in bonds, long-term bonds, we would have right now $71. If we had invested, however, in the top 500 U.S. companies in U.S. business, we would have $2,658. Exponential returns. Now, the fact is that works out to about a 10% annual average return. But the retail investor has only made 4%. What happened to the other 6%? What happened to all the money? Well, what happened was investing mistakes. Principally, the two main investment mistakes are not enough or inaccurate information and paying way too much money for investment services. We're going to talk about all of the investment mistakes that investors typically make. But first, I want to cover 3 points. First of all, stocks are part of a life plan. No one should invest all of their money in stocks. First, you have to have an emergency fund. You have to have a down payment for your home that you live in. You have to have insurance. You have to have a health savings account. Get your basics covered before you invest in stocks. Part of a life plan. The second point I want to make is that this seminar is about stocks only. There are a lot of other different asset classes. Bonds have a very important part in an investment portfolio, but we're not going to deal with anything except stocks in this portfolio. Derivatives, which are puts, calls, options, futures, those kinds of things, we don't deal with in this seminar. We consider those basically gambling bets that we place on stocks. They're all derivatives of stocks. The only real investment there is an investment in U.S. business, which is basically buying a stock. The third point I want to make is that buying stocks is a long-term proposition. It takes at least 5 years of an investment horizon to invest in your portfolio. If you have less time than that, you're not really investing, you're just gambling. So what we want to do is have a commitment to our stock portfolio. We want a commitment to our stocks. So now that we have those 3 things, we want to understand that investing in stocks for the short term is very risky, but investing in stocks for the long run is a very solid investment. Now that we know that, how do we do it? Basically, what we're doing is we are competing against Wall Street traders as well as other investors when we buy stocks. I worked on Wall Street for 5 years. I was fortunate enough to work at the biggest trading office on the street for Lehman Brothers. I was fourth generation on the street from my family. And I learned very quickly that the most important thing you need to be a good investor is accurate, up-to-date, and complete information. Now, if you've ever visited Wall Street, which I highly recommend, you'll see that the traders are connected. Not only are they right in the middle of the action, but they also have earphones on, they have people telling them things all the time, their smartphones going, their computers going. They are connected all over the world to get the best, most accurate, and up-to-date information first. How can we compete with that? If they can be right in the middle of the action, how can we, out here in the other 49 states, get the kind of information we need to compete with the Wall Street trader? Well, I will tell you, we have a couple of advantages, big advantages. Our first advantage is time. Now, that is something that the Wall Street trader doesn't have, is time and patience. Why? They're a trader. We are an investor. We can take our time and look at the long-term news. Long-term news is different from short-term news in that it will propel the stock slowly and steadily over time. Businesses, U.S. businesses, move slowly and steadily over time. So it's natural for us to take our time and for the company to grow, hence an investment. The Wall Street trader, he needs to make money today. His boss is on top of him. His boss does not care what he's going to make in 6 months or 3 months. He wants to know, what have you done for me today? That's why they come up with all of these derivatives and all these gimmicks on Wall Street to try to get ahead of the other guy on the trade. We're not trading here. We're investing. We're going with the flow, and we've got the advantage in time. Let me tell you, the Wall Street trader doesn't care about the long-term news. If we buy on the good, solid facts, the Wall Street trader ignores, we are going to have the advantage over the Wall Street trader. The next advantage that we have is simplicity. Simplicity gives us control, and it helps us to lower our costs. Now, Wall Street is very complex, as you know. If you've ever watched some of those trading shows about the spreads and the eagles and the combinations, you know it's very hard to understand. A stock, however, is very straightforward. What you see is what you get. You're simply investing in a company, a U.S. company, a big, strong U.S. company. But when you buy the derivatives, you're buying something that's not even a solid asset, and you're going to pay a lot more to do trading in those kind of derivatives. So when you buy a stock, your costs are very low, and what you see is what you get. And this allows us to have control over our investments. It's become very inexpensive to buy stocks nowadays, so that whole trend is with us as well. We are buying something of real, tangible value. Another way simplicity can help with us is that we don't like to buy packaged products. Now, a while ago, and I'm talking about mutual funds and ETFs, a while ago people came up with the idea that for diversification, we could buy a pool of stocks and have a professional manager run it for a small fee. The problem is that it really is no longer a small fee. There are layers of fees in mutual funds that most investors are not even aware of. And this manager who's managing our money, we really have no idea what he's doing. Now, a mutual fund is required to send out reports, an annual report and quarterly reports. And if you look at a quarterly report, you will see that you get some information. You see how much the fund is worth at the end of the quarter, and you also see what the top 10 stocks are and what they were at the end of the quarter. But you get no explanation of exactly where they bought them or what they were doing all along the quarter with your money. You've given over control of your money to the manager of the mutual fund. The other package products that's very popular right now are exchange traded funds, or ETFs. Here we've gotten rid of the manager and we're buying a list of stocks, similar stocks. There are fees in these as well. And in addition to those fees that are hidden in many cases, there's leverage. Sometimes we buy a list of stocks, we're really not getting the stocks, we're getting a reflection of the stocks, and there's actually borrowed money in that portfolio. So we're paying for leverage, and we really are not buying a real asset in many cases. We also have no control over this portfolio. We can be watching the news and see that one of the companies on our list has gone down pretty dramatically, and basically we have no way to sell it. We can't just pick up the phone or go on our computer and sell that stock. We are stuck with it, whether we like it or not. It takes control away from us. So basically, an ETF and a mutual fund takes control and raises our fees, and we want to keep our fees low. The other thing so what we have here is a review. Remember, stocks are part of a plan for life. This is not a casino. We are buying stocks only in this seminar. We're only dealing with stocks. And investing in a portfolio of stocks is a long-term proposition designed to build your wealth. Your commitment is required. Our allies in this journey are good information and time. Our main weapon is patience, and simplicity gives us control and lowers our costs. Thank you.